And the big factor that we're talking about and what I was concerned about was that they were buying houses at the top of the market. So I remember doing a video a while back on a company called OPENDOOR, and this video actually got a lot of hate. And my whole argument was that Zillow was getting out of the iBuying. They could see ahead that there was possible bubbles with the housing market, and I think their margins were also an issue. Now, mind you, it was a $15 stock when I made this video, and I warned people, beware of OPENDOOR. They had a lot of debt, and a lot of their debt was like revolving debt. And that was my concern, was what happens if the housing market slows down? What happens if interest rates rise? What would happen to OPENDOOR's business? Well, we can see here that a lot has happened since then, and it went from almost a $15 stock down to a $2.13 stock, down 8% more today, almost 9% actually. I just do my best to be unbiased and give you guys what I see. I'm not perfect, I'm not an expert, but when we look through financial statements and we see a company burning money and they're taking on more and more debt and burning more and more money, it's usually a disaster for the company. It doesn't usually end well. Now, the stock market will make you look stupid sometimes, as I literally just looked at Corsair Gaming's earnings not too long ago and thought it was pretty bad, but overall the market liked it and the stock is up over 12% today. And when I looked through the quarterly report, there was things I did not like about Corsair Gaming's report here, and the big thing was absolutely the margin seems to be an issue, and the fact that they're burning a crap load of capital. Somehow they believe they're going to finish the year out very strong, grow their margins, and actually have positive EBITDA. That will be an interesting task to see if they can do that. I'm not so sure that they will, considering I think the consumer is in a little bit of trouble here, but who knows, maybe they'll keep racking up those credit cards and Corsair will get out of this woodwork, but they still have to deal with the fact of next year. The margins are only 3.5%. Even if they go up to 5%, I still don't see this being a company that I would be interested in buying. Even if it went up to 10% margins, I still don't think I'd be interested in buying Corsair. Using tip ranks, we can see that we have a moderate buy on the stock at $6.63, a high of $13 and a low of $2. So whoever called that $2 is right on target, man. You're about ready to hit that price target today. That $13 price target, boy, oh boy, do you have a lot of work to do to get to that point, which goes to show that even the experts don't really know what the heck's going to happen to the market. So what I want to do is just rip through their financial report, as this is a company I really haven't been interested in looking at in some time. But I will say that I think it's possible that there could be some value here with the amount of assets that they possibly accumulated. If they can handle the debt load, I tend to think that this could be an interesting company heading back into another housing boom. But who knows? Let's dig through it really quick. Once again, we have tremendous revenue growth, top line revenue growth, but we know that they're possibly burning more than they're making, as revenue came in at $3.4 billion, up 48% versus third quarter of 21, which they sold 8,520 total homes, which is up 42% in third quarter of 2021 as well. And the big factor that we're talking about and what I was concerned about was that they were buying houses at the top of the market. Even though they are getting a deal and getting direct to the home seller, I thought they were buying at the top of this market, and it didn't seem like it was a great opportunity to be buying these properties. You want to be buying properties when people are selling them for pennies on the dollar, and that is definitely what was not happening. As we all know, it was a housing boom, and I saw people buy a house for $200,000 and 3 months later selling it for $350,000 and $400,000. Nothing changed with the house. They didn't add square footage. They didn't even put paint on the damn thing, but it went up in price. And guess who was buying those houses in that market? It was OPENDOOR. Gross margins at negative 12.6% versus 8.9% in the third quarter of 2021. Now, here's what I remember about OPENDOOR. I remember them having pretty good margins when they first got into the space. And I stated, guys, go back to that video and watch it. I stated that these margins were unsustainable, and in any sort of housing correction, 20% is not a lot of margin in the housing market. I've seen negotiations get cut by 20%. Let's use, I'm selling a house for $360,000 and I decide to take $310,000. Well, after fees and all documentation, I basically lost my 20% right then and there. And trust me, that is what's going to be happening in the near future, especially if we get a wave of layoffs. And they're already dealing with margin compression without waves of layoffs and without consumer weakening so far. Now, with the raise of interest rates, we're obviously seeing a slowdown in the housing market, and this is definitely impacting their business and it's impacting the stock. I just want to see if there is opportunity within this stock. They're expecting fourth quarter revenue to be about 2.3 to 2.5 billion and adjusted EBITDA at negative 355 million. So if we were just looking at top line growth, you would think that this stock is an absolute steal. It went from a $15 stock when they were doing $4 billion in revenue down to a $2 stock when they're doing over $12 billion and possibly doing about $15 billion by the end of the year in revenue. When we take it down to net losses on the year, for the quarter, they lost $928 million. For the year, they're losing $954 million on $12 billion of revenue. And what else are they doing? They're diluting you on top of losing money, going from 585 million shares outstanding to 629 million shares, call it 630 million shares outstanding. So a substantial amount of shares in the last year put on the market as well. Now, here's where it gets interesting. If they somehow can turn a profit here, the stock is very cheap, as they do have 1.3 billion in cash, and the market cap is pretty much sitting at 1.3. We can see stock-based compensation coming down here. They're probably firing people, and the business is probably heading in the wrong direction, and therefore they are making some cuts. So if we do go through another housing boom, I actually find this company to be a little bit interesting to keep an eye on here. Now, I do think it's pretty ugly right now, but I would say that if somehow the consumer gets out of this and Opendoor still can stay afloat, and we're talking about the end of next year and we get out of this recession, interesting opportunity, as there is a shortage of houses, and if they can get their margins in the other direction and they can keep their current assets somewhat elevated here, and you're buying it for right around that $1 billion mark here. They have $6 billion in assets. They have over $1 billion in cash, and the stock market right now is pricing this thing to basically go bankrupt, which high probability, but it's an interesting stock to keep your eye on if they can move margins to the positive. And if we go through another housing boom where they can get premium prices for their properties. So just an interesting stock to keep an eye on. I still don't like it, guys. I would wait for the economic backdrop to kind of support this company. But as I stated before, the market can make you look stupid sometimes. And for this one, around $15, I knew it was bad news. Around $2, can I say that I'm surprised that's at $2? I'm really not. When I was looking at the revolving debt, what was going on with the economic backdrop, the fact that they were buying properties at the top of the market, definitely had a lot of concerns with Opendoor. But I would say it's a little bit interesting at these levels. As always, guys, appreciate your time. Thank you so much for spending it with me, and we will see you next time, investors. Peace.